Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Consolidated Edison, ticker ED. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. They operate in the multi-utilities industry. They have a market cap of $35 billion, enterprise value of $58 billion. You can see there is basically $23 billion in net debt being added to this business to provide a decent amount of leverage. So, business description: they provide regulated electricity, gas, and steam delivery business in the United States. Offers electricity services 3.5 million customers in New York City, Westchester County, Manhattan, Bronx, Queens, Westchester County. Also operates transmission lines, substations, service lines. Primarily sells in, looks like, New York. So the beta of 0.22 tends to indicate low volatility in the stock price, which tends to correlate with low volatility in the business, tends to be higher quality. However, when I look at return on invested capital, I have some immediate concerns. You have this line here that's 7.5%. So 7.5% means that they never in the last 20 years had a return higher than 7.5% on the return on invested capital. That's a very low number for return on invested capital, and so I don't like to see that. I would generally like a company where every year is higher than 10%, and yet they have 0 years above 7.5%. Now, what is interesting here, too, in favor of the company, is they have 20 straight years of profits. Now, being a utility company, being regulated, you can pretty much guarantee that they're going to have some profitability every year, so it is good in that sense. But the low returns on the capital is where the concern is for me. Now, as I break down further in here, you can see these are pretty low numbers. Most of the last decade is below 5%. Looks like you haven't been above 5% since 2008. Pretty low returns on capital. That tends to be a sign of a low quality business. Now, return on equity is higher. Again, you have this big leverage here, and that leverage is allowing you to get a higher return on equity than your return on invested capital. Lots and lots of debt. And what that really means is if you're able to get debt at a price lower than your return on invested capital, then your return on equity is going to be higher than the return on invested capital. The more debt, the cheaper debt you can get, that's where you get that driver. Now, where I have concerns, though, is valuation, okay? Valuation is a very big problem here because your price to earnings is 23 on a business that only has a return on equity of 8.8%, and your revenue growth is anemic. 0.6% is basically flat over the entire decade. You begin the decade with $12 billion in revenue. You end the decade with $13 billion in revenue. So there is some growth, but you can see that basically the entirety of that growth comes in 2021. From 2012 to 2020, you had no growth. 12.1 billion, 12.2 billion, basically flat. That's a major concern because it means that you're really not being able to drive further profits, further growth. And if you can't grow your revenue, then you're not going to be able to keep up in terms of earnings per share and everything like that. Your assets growing at 5%, though, substantially faster than your revenue, which means you're going to have exactly what we see here, declining returns over time. And that can be a real problem, especially when you think about what's happening to debt markets right now. So your return on invested capital is 3% in the last year. But what happens when debt is 3%? Debt becomes 4%, debt becomes 5%, debt becomes 6%. All of a sudden, the company is upside down, and the cost of their debt might exceed their return on invested capital, which could cause them to enter into losses or at least lower and lower returns on equity. Big concern. Again, there's not a single year here with 10% return on invested capital. There's not a single year here of return on equity. All these numbers are very, very poor. Now, you do see dividends being paid out. Most of your money is being returned as dividends, $3.86 per share, $3.85 per share. You can see $3 in dividends. This is basically your entire return. Your entire return in this company is going to come from the dividend and the growth of that dividend over time, which looks like it's, again, hardly growing, but it has grown, 20, 30% over the course of the decade. That is something, but it's not much. It's talking about like a 2 to 3% growth rate. Now, we're at $3.10. You have a $100 share price. Easy to say you have a 3.1% dividend yield. Let's say it's going to grow 2% a year. Now you're basically saying by buying this company, you're going to get a 5% return on your investment. So if 5% is good enough for you, then this could be very attractive because it's going to be low volatility. We have this beta, but 5% is not good enough for me. So to me, I see this company as extremely overvalued. If I want to get a 10% return, then I need a dividend yield of 8% because I'd have 8% plus 2% growth. So to get a dividend yield of 8%, yeah, it gets really hard. So dividend yield of 10% would be a $31 stock price. Dividend of 8% would be something like a $36, $37, $38 stock price. I mean, you're talking about the price falling by almost 2/3 in order to get an attractive price here. So this price certainly needs to be under $40 per share in order for me to even be remotely interested. And I wouldn't buy it anyway because the revenue growth is just too low. But maybe we can learn more, see if there's anything else to work out on the other pages. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. I'm working on putting out 3 videos a week, Monday, Wednesday, Friday, covering new companies in the S&P 500 every single week. If you want to see those companies, you need to be subscribed so you can get notified as I upload those videos. Now let's look at the income statement. Now, one thing that's interesting is the cost of goods sold has gone down over time. Now, I'm wondering if some of that is declining in cheaper prices to produce the electricity or natural gas, something along those lines. And that's actually helped out their gross profit grow, despite the fact that they've been unable to grow their revenue. That's been a big driver here. You've seen that their operating expenses, other operating expenses, though, this can be your overhead, has grown significantly over time. So it's basically completely offset the benefit they've gained from the operating leverage on the gross profit line. They've completely lost it on the SG&A line. This is a management issue, and this is probably luck. But, give some credit to the company. They are doing good work, improving their gross profit. I just don't know how much of that is within their control. You can also see they are diluting shareholders over time. So it's going to be even worse than what I said, because you're not going to be able to convert all of your growth into money that the shareholders can receive. So your dividends are not going to are going to get diluted based upon the shareholders. I mean, you've basically been diluted 15% over the past decade. 1.5% per year. So maybe your dividends growing. You're not putting out high enough returns on your returns on capital in order to get high returns for shareholders. Now, if you go to the balance sheet, you can see this massive growth in PP&E. They've grown, basically doubled their PP&E from $25 billion to $49 billion. Think about that, though. They've grown their assets by 100%, and they've grown their income by 10%, 20%. Let's be generous and call this 30%. They've grown their income by 30%, but they grew their assets by 100%. You can't do that again for the next decade and expect your returns to be even remotely good, especially if the cost of debt goes up. Because look, debt's gone from $10 billion to $22 billion. They've more than 100%, more than doubled their long-term debt. It's a really, really terrible setup here for future returns in this business. Cash flow statement. Look at these big depreciation numbers. You're having to put a lot of money back into property, plant, and equipment. This depreciation number is growing very, very fast. It's growing substantially faster than your cash flow from operations, which means that your net income line is going to be constantly under threat, especially when you think about how much larger PP&E spending is compared to where it was at the beginning of the decade. So you can just forecast again, 1 decade later, the depreciation matched the beginning of the decade. So maybe in another decade, your depreciation is going to be $4 billion. I mean, that's going to completely wipe out your net income. This company is just set up for very poor future returns. Let's see if there's anything in key ratios. Again, all the numbers here are low in terms of returns. Your margins here are low. You have negative free cash flow margins for quite a few years recently, the last 6 years. That's actually terrible. I can't invest in this company. This company is a very poor quality business because it has low returns on capital. It's very overvalued. It should not be valued at anything more than something like a PE of 8, which means the company needs to fall by 2/3 in order to get to a reasonable amount because they're simply not growing their revenue fast enough and they don't have the returns on capital. You can't pay more than price to book for a company that has a return on equity less than 10%. Just lots of very, very bad setup here. So that's my summary for Consolidated Edison. If you enjoyed this video, please hit that like button. The YouTube algorithm uses those likes to recommend it to other people. So if you're enjoying my content, I would appreciate if you like all the videos that you enjoy. Also, you need to be subscribed so you can get to see all my future uploads. I work through every company in the S&P 500. I've already done well over 100 of them. There's a playlist available on my channel that you can look at all the past 100 episodes covering the S&P 500 companies. And if you enjoyed this software, QuickFS, consider signing up to quickfs.net through my affiliate link, which is the first link in the show notes below, which is just there in the description. You click the description. If you sign up to my affiliate link, then I would get a cut of any future commissions from you signing up for their service. You can also start with free service. You don't have to use their paid version, and that is one way to get started. Try it out. I really use it. I use this software myself. This is not promoting them for any other reason other than that I enjoy the product myself. So thank you for listening, and until next time, start paying fees, start building wealth.